Should you now start actively hunting for a good bargain in real estate with prices at a 5-year low adjusted for inflation? We've already culled out very compelling reasons for a first-time or end user to buy a home and take the plunge and not wait on the sidelines anymore. But what about investors? Shall we go ahead and put all our money in stocks, or can we still diversify with one other real estate asset in our portfolio? Sameer Jasuja, you know, we've always believed that, look, it's good to have a home that you live in. Of course, that's got social value, that's also got an emotional value. And in the past, we've also been saying that have another home. Rent is inflation proof, and it's also a hard asset to own. Today, looking at the market condition where investors have fled the market, are there any spots that are investment worthy?
Well, Manisha, I would not recommend investors to look at the real estate market, at least for the short term. For the investor, there's still a lot of pain left in the market, majorly because of the oversupply in both ready and under construction stock. The confidence levels of the customers and has to come back, really, whether it's an end user or investor. And many investors are stuck right now who need exits. Till those exits don't happen, the fresh set of investors are not going to come in, because there's no return really expected in real estate, at least on the residential asset class. Of course, commercial asset class is still looking very attractive, and rental returns are letting many commercial assets getting sold to high net worth individuals. Even though one thing that I'm seeing as a first-time trend in residential real estate is that because developers are today desperate to sell real estate, they are offering assured returns even in the residential asset class, which has never been seen and has been totally unprecedented before. And I would recommend all investors not to go and be very careful of such schemes, and they will be stuck.
Absolutely.
They could get stuck very badly, like many assured returns.
Very badly.
Customers have got stuck in the commercial segment as well. So
I agree, and thank you so much for that warning.
Yes.
Let me move ahead.
Harsh, at least for the next... Sorry.
Okay. Harsh, I'm going to come to you. What's your own view? I mean, you won't deny the fact that we've always actually had in the past said it's not a bad idea. If you need to diversify your assets, you have a market which is at an all-time high, liquidity chasing it, doesn't seem to be pausing for breath, expensive, inexpensive, yet you have an asset class which is surrounded with all the gloom and doom that you can hear of. What's your view?
So I think one, to have a property as an investment, you need to have a huge portfolio, because it's a lumpy portfolio. It's a lumpy asset. So, I mean, and it cannot form, in my view, it cannot be more, should not be more than maybe 10 or maybe 20% of your portfolio. So your portfolio needs to be huge to be able to absorb a 10-20% thing in real estate. A bigger thing is now fresh kind of investments are available. Rates are available, which will typically give you exposure to commercial property, where you can limit the size of your investments, you can diversify your investments. Currently, mostly that's likely to be commercial property. Maybe going forward at some point we would have others as well. I think we are soon going to start getting derivative instruments, and those derivative instruments would do well, even whether it is a portfolio investment or something. They would now start doing reasonably well as the underlying market would, because of the regulation being in place, and therefore the lumpiness of the asset might go away. And instead of investing in a single asset, you might invest in investment managers such as Amit or somebody else, whosoever is raising money for this.
Okay, fair enough. Amit, what's your viewpoint? Very quickly, we're running out of time.
So I think one is a matter of what is your allocation to real estate first. Secondly, as markets mature...
So Harsh said up to 20% is not a bad allocation, provided then of course you need at least a portfolio of 8 crores to have 20% of real estate, isn't it?
Valid point, but at the same time, we also have to see as the market consolidates and matures, we also will start behaving like equity markets. where a fund manager can do a better job than you taking that risk, a concentration risk in one city. So it is better to go through a fund manager and diversifying your investment in various cities.
Okay, all right. Anuj, last word to you and we'll wrap out.
Yeah. So, Manisha, my thought is what Amit and Harsh said is if you leave the fund management and REIT, which I think are very good investments on one side, if the buyer wants to invest direct in property, short-term investors, not a good time. I completely agree with Samir. I think on the mid-term, long-term, I am going to change my stance from saying is no, it's not a good time to say start looking at it. But I would say is investment up to 1.5 crores of residential properties, which is under construction in RERA approved projects, because I do believe is that the rental returns will start to go up. So 1.5 crores, mid to long term investor, good, short term, not good. And then what Amit and Harsh said is absolutely correct. Invest in funds and REITs as and when they come in.
Okay, specify mid to long term for us.
So 3 years onwards, minimum 3-year horizon.
3 years onwards.
Not like what NCR did in short term.
Okay, no 3 months rotation of money in real estate. That game is out, I think. Most investors do know that. Gentlemen, thank you very much for joining me today on this discussion. Well, buying your first home isn't a spreadsheet decision. It's an emotional and a social one. And I can say the universe seems to be aligning in every which way for the first time or an end user home buyer to go out there and buy and get great deals. Starting next week, we bring you a special show dedicated to making your home buying experience an informed one. So do join us at 6:30 p.m. on 26 July. That's the date. Don't miss. Goodbye.